How are Australians coping with high interest rates? It's a question on a lot of people's lips at the moment. Interest rates are at their peak point at 4.35%. Borrowers were only stress tested between 2.5% to 3%, and interest rates rose by 4 percentage points over the last few years. That raises a question: how are Australians coping? That's exactly what we're going to go through here today. In fact, it's a question that the RBA have been paying a lot of attention to and putting a microscope on. How are Australian consumers and Australian households being able to survive through this situation, and are they under serious pressure? Curtis, how are you?
Yeah, excited to go through this. We've got a new setup, so we're, I guess, coping with higher rates okay on the basis of this, but we'll see how it goes. But yeah, there's the RBA released their financial stability review recently, which has a very data-rich and unpacks some of their thinking on this. So yeah, it's a good time to go through it.
Yeah, it's a report I've been reading for like a decade straight now. One of my favorite ones to go through, and you can tell reading these report where the RBA's concerns are and what they're paying attention to most. And the really cool bit about this is we're going through a little bit of an experiment right now in Australia. Like, interest rates have risen for the first time in like a decade, and they've risen a lot. We don't know how Australians are going to respond to that. We're kind of feeling our way through and hoping that the Aussie household can survive through it. That is what the RBA is traversing at the moment through the Australian economy. And we're getting a little bit of a sense of it now because we're 12 months in. We're at the point where we're most likely at the peak point. There's been a pause for a number of months. No one's really expecting further rate rises. So we have lived through high interest rates now for a period of time. And we're now monitoring how Australian households are going. And the early part of this experiment, like I find, is we're getting a bit of data that says, hey, we're going to get through this. It's going to be okay. Is that your read on this?
Yeah, pretty much. And I think that's where, economics is quite interesting. Unlike other sciences, it is a bit of a live experiment, and there's no set point where things break. So things are being pushed and things are bending, but you don't know when something's going to break until potentially after it's broken. So that's where, like you say, it's a bit of a live experiment. And the signs so far are that we might get through this without anything breaking too badly. Obviously, It sucks for a lot of households, and that some of that is reflected in the data. But in terms of really bad, like economy-wide impacts, so very high unemployment, institutions failing, financial stability issues, some of the real big red flags. They're not really showing up. And, from what the RBA have researched and are showing, they're kind of flagging that they are pretty bullish that we'll get through it without any of those major things, just kind of the pain in the household sector that we're already experiencing continuing for, a further 6, 12 months, whatever it may be.
Yeah, exactly. This is bucking history a little bit. So, we don't have any recent history on this because we haven't had an inflationary episode for, decades really. But the old history, looking back at it, is when you have an inflationary period like we did in 2022, it responds with, it needs a break to fix that inflation problem. Meanwhile, inflation's sort of come back down pretty close to ban, not quite there yet. And yes, we are going through pain, and we will talk about that in detail through this, but we still have a very strong employment market. We're still growing, albeit slowly. We have positive economic data through this, and it's definitely not broken. It's hurting, but it's nowhere near broken. And that's a really, really positive outcome. This soft landing story, the Goldilocks scenario that the RBA were hoping, that not many people believed when they were reporting it out a couple of years ago and suggesting that we might go through this path. We're living. We're actually going through it. It's happening. And it's not only Australia, it's across the world too, who are a little bit ahead of us. And the data that they're seeing suggests that, hey, they're going to get through this okay. That is my takeout from this report, along with a lot of richness in the data about the household sector. So let's go through specifically how Australians are coping. So the first reason that the RBA back with, and the most obvious reason is the jobs market is on a tear. It's doing really, really well. Let's run through that. Why is this so central to Australians coping with the high interest rate environment we're in at the moment?
Yeah, and I think this is something that will get a lot more attention over the next 12 months as well, because the unemployment rate is key to your ability to get through this with pain, but without anything breaking badly. I guess it's, in practical terms, if you zoom down to a household, if there's weakness in the employment market and people have to pick up a second job, or their employment terms change a little bit, people can manage their way through that. If you're in a situation where people are losing 100% of their income, so they don't have a job, there is no solution for that individual household.
Then I know that one.
Yeah, there is no solution. And if you play that out across, tens of thousands of households, hundreds of thousands of households, that's where you get some real economic damage. So while, there's underemployment, a shift from full-time to part-time, all these things that are a bit negative, that is more manageable. If unemployment starts increasing really, really significantly, like I say, that's you getting into the territory where there is no solution for those households. And that kind of, has much larger consequences for the economy. So that's why they're watching it so carefully. I think their rhetoric is still, they're, quite bullish on it, and they don't really want to flag, rate cuts yet. But that is something they will be looking at, because if that goes to like 5%, that's there is nothing they can do to fix it, if that makes sense. The kind of recessionary conditions will come, and that's the end of it. That's that, basically.
Yeah, I'd call that broken if it gets
exactly
to that far. And that's a little bit of a scary scenario. But that is so true. Like, living my own experience through that, when our family lost our home as a kid, it all started with a job loss. That was the starting point. It doesn't happen straight away, but when you lose your job, the entire household structure, stresses, finances, decision-making, what's possible, what isn't possible, that's where it all changes. It all starts with a job. So the general line, a job is the best form of welfare, I 100% believe it is the best thing a government can do to help support Australians, is create a strong, healthy jobs market that gives people options.
Yeah.
And that's the beautiful thing about this transition, and the legacy that the RBA has kind of put in place over the last few years. The post-COVID legacy is we have had the best employment market in 50 years in Australia. And through this high interest rate, high inflation environment, a year and a half later, excluding a sort of 18, 24-month period where it was Goldilocks, amazing, right? It's the best employment market in 50 years still today. The unemployment rate starts with a 3. The number of people employed is higher than ever, or just about there. It's still really, really strong. Even though it's weakening a little bit, it's still incredibly strong. And that means people have options. So if you're really struggling as a household, you can go pick up a second job, and you can go find a way. And that gets into our second little answer here. The RBA's second answer is households have responded. They've been put under pressure, and they have responded. They are responding to higher interest rates by adjusting their circumstances. That isn't just only on the expense side, it's also on the income side. And the hustle, they're hustling. Australians are hustling to get through this scenario.
Yeah, so like disposable incomes are down. I think the stat that the RBA had was real disposable incomes are down about 7% since 2022. So, inflation over that period has been very, very high, much higher than wage growth, which essentially creates that gap where, every dollar that you've got is going less of a distance, which, everyone feels. But yeah, like you say, at the moment, people are adjusting their income side of things and their expense side of things in order to make ends meet, in combination with their savings buffers as well. So, the RBA have also mentioned that people are drawing down on some of their savings, but essentially households are playing with the individual levers they have to squeeze by without going into kind of distress, at least on aggregate.
So that's a conversation that we have all the time now. We're speaking with borrowers and households out there, and they are telling us that they are being much more financially conscious with the decisions that they make. compared to the 2% rate environment post-COVID, where money was just floating around everywhere and everyone felt really, really confident with their own cash flow position. Nowadays, households are more conscious with their spending and looking at their budgets and seeing where there is a bit of fat that they can trim. And that's really making up for the increase in expenditure that they have on interest payments that have kicked in to their cash flow position. So they're spending a lot more on interest. Interest payments are up. Mortgage repayments are up 50, 60% a lot of the time. And it was already the highest expense, and now it's up 50, 60% inside such a short period of time. So, when you do that on your own little budget, you can be like, okay, cool. If that's going up so much, where can I cut back? That's a conversation that Australians are having. They're becoming more diligent about their finances through this transition. And that is the second point that the RBA is talking about adjusting patterns. It's not only on the income side with having potentially second jobs and hustling their way through it. It's also cutting back the unnecessary expenditures and trimming. And you're seeing that in the GDP data as well, where you pick up the retail component being fairly weak and consumer spending being fairly weak as part of our GDP output measurements. We're seeing that response being picked up in the economic data as well.
Yeah, and that does have an impact. So that is the slowing of the economy, basically. Okay, yep. So there's some negative economic consequences of that household level decision making. Yep. But again, within kind of benchmarks, I would say, of what the RBA are targeting and what they're shooting for, which is, growth still positive. It's barely positive, negative per capita, but it's barely hanging in there. But it's not going backwards in a really, really bad way.
Yes. New Zealand's going backwards, so yeah, we're positive. Go Australia.
So it's just positive. So it's not flying, but it's just barely meeting benchmarks.
Yep.
And that is probably a story that's going to continue because the policy levers, I guess, that the RBA have and that the government has to some extent. Fiscal policy, I don't think, is really slowing things down very much. So the onus is on the tight monetary policy settings and high interest rates, basically, to slow the economy down. Yep. That means, essentially, the economy slowing down comes back to households spending less and doing less as the transmission mechanism for that slowdown. So while interest rates remain high, it's going to be difficult for economic growth to go very far.
That's true. Yep.
But that's kind of the way it's been structured, basically.
Yeah. So this comes down to a little bit about perspective and the relative position of how we benchmark. If we benchmark current conditions to our average level, then you'd be like, growth is slow, unemployment's beginning to rise, the economy isn't doing all that great compared to average conditions. But the reality is, we are through and still in the post-COVID economic policy era of managing everything that we needed to do to get through COVID and all that incredible stimulus that we put in place. We're taking it away, feeling the inflationary impacts and getting through that, very difficult economic circumstance and the response that we had to put in place. We're still not fully out of that period. We're still kind of in that little period of economic management. We're at the tail end of it with inflation coming back down. And that inflation sort of scenario is really a COVID-induced scenario. It wouldn't have happened without COVID. It wouldn't have pumped so much money into the economy. So we're kind of at the end of that period. So when you take it with that benchmark, we had COVID, and that's the benchmark of what we're applying for, this is pretty good. Employment conditions remain fairly strong, and we're going to get through this without a recession at all. And we've just had to inflate our population through this and inflate our currency, deflate our currency a little bit, and have an inflationary period, move backwards a little bit as people, but keep everyone employed. I think that outcome isn't all that bad for the size of the problem, a gigantic size problem of closing the economy down for 6 months plus. The actual medicine that we're going to face through this probably isn't that bad, and it's a function of good policy making that gets us through it.
Yeah, I think, it's where we're going to be at the end of 2025. That's probably the way to think about it. If unemployment is below 4.5%, and growth is positive, maybe, tiny bit positive, but it's not going backwards. Basically, we're not in a recession. Might not be growing much, but it's technically positive. Inflation is going to be back in band then. That's a pretty good scenario where effectively, maybe real disposable incomes have fallen by 10%-ish over that window.
Yep.
But that is inflation, if that makes sense, where you got inflation running at 8, disposable incomes are going to fall. If that's the long-lasting consequence, that's getting out of this period pretty well. So I think that's what everyone's shooting for. That's the best case scenario. And even though the RBA are still very, very reluctant to talk about rate cuts, which is obviously the thing everyone's, I guess, excited about or wants to see because that relieves a bit of the pressure, they are increasingly bullish and increasingly positive about the ability to kind of land this plane, so to speak. So I think that in of itself is a little bit of a good news story. I don't think they want to talk about rate cuts yet for, their own signaling reasons. But yeah, a lot of I'm picking this report and that they've released and some of their thoughts in it. They are increasingly confident that they're actually going to land this thing in 2025 with a lot of these metrics looking pretty healthy.
They are. Yeah, hopefully. We're on a path that's getting there. And that is hopefully the end outcome here. Obviously, I love seeing good jobs scorecards. It's great for the Australian people if we have jobs through this transition period and there isn't a major employment shock through it. So
actually, I'd be interested for your thoughts because reading this report, this is one of the joys of having the Michelle Bullock do the press conferences now. I thought what she says in her press conferences and how this report reads to me are like polar opposites. Like the press conferences are, inflation's a problem. Obviously, she is unsure about what the future direction is going to be. I'm looking at data. I don't know if we're going to pull this off or not. Like, we'll see how we go. I'll be back with you in 6 weeks to give you another update, but fingers crossed. And this report, if you read it, it's like the RBA being like, we are shooting the lights out of this thing. Can we have some kind of reserve bank, is there some international awards or something that we can submit ourselves for because we are absolutely nailing this and we are going to bring this thing home.
I'd put a little bit of context to that. This is where the history of reading the Financial Stability Report over a long period of time. Man, they present scenarios, they present problems. Like this question that they have in this particular report is how do we look? How does the Australian household look? How does the commercial real estate sector look? They ask the right probing questions. They pick an area and they never find a serious problem. They can't be out there being like, hey, look, the commercial real estate sector, it's a problem. Guess what? We think it's totally screwed. They never say that. They always say, hey, we have identified a problem. Here's some charts and statistics. Here's our reasoning. We never really identified a problem. To their credit, though, there hasn't really been that much of a problem through it. They did say this about the fixed rate rollover. Go back 12 months in their report 2 years ago. It was about the fixed rate rollover. They said it's something that's happening. It's a problem, but we don't think it's going to be that much of a problem. The Australian household will respond. And we're sitting here 12 months later and they're exactly right. So
I just think that the way they present it
very positive generally
is a lot more bullish on paper than in person, which might be a little bit of her jawboning. And you say, a lot of the things they've raised, commercial property market, they mentioned, China is a big one. They kind of identified the risks there as being largely external, being like, look, there might be tightening credit conditions in commercial property overseas that have an impact. There might be issues in China that have an impact, but they're not identifying things that are domestic or that they have, or that anyone in Australia has any kind of direct policy control over. And the things that they do have direct policy control over, or the government does, or other, financial regulators have control over, they're kind of very bullish when I read it. Anyway, I just thought it was interesting. If you brought someone in from the UK or something that had not followed anything to do with Australian economics or finances, and you gave them the executive summary of this to read, and then you took them to Michelle Bullock's press conference, I think they'd be is that the same lady that wrote that? I just thought it was interesting that they're prepared to be a lot more bullish potentially in something that almost no one reads. We read it. Whereas the thing that's on, Channel 9 and Channel 7, they're a lot more careful.
Yeah, that's true. Let's circle back to the third reason that the RBA have come back to back to the opening question, how are Australians coping? The third reason that the RBA has come back to is the starting point. The starting point is we were flush with cash. Offset balances were really high. The savings rate was up near 20%. We couldn't really spend our money. We were locked indoors, and like all the areas where we wanted to spend our money, couldn't even buy. So, people's savings balances were really high. So effectively, they came into this period, into this high inflation period, with an incredible amount of financial resilience the household sector had. So that starting point is a big reason why we are coping or have coped so far. But the longer interest rates remain at this level, the more of that starting position, the stock of savings people have, begins to be dried up. And this is also being shown in the data itself, particularly for higher income quartiles, which showcase a drop in the number of the size of offset balances and redraw balances. So high income quartiles with big mortgages are now dissaving a little bit or taking money out of their offsets. It'd be hard to unpack exactly why, but we are starting to see a reversal in this. The savings rate has come down a lot over the last few years. People are saving less money, and the total stock of savings is coming back down as well, as it's being eaten up by this higher rate environment and higher expense lifestyle that people have with everything costing a lot more.
Yeah. So they put out a interesting chart on this. So I've got it here in front of me. They split it up by people who have mortgage debt and people that are renting. So pre-pandemic, the average kind of liquid savings base was about 3.5 months of coverage. And then during COVID, on average, people added another month to that. So they've got 4.5 months of coverage, which doesn't sound like much, but like in percentage terms, going from 3.5 to 4.5, is a decent change. Renters had a bit of a smaller savings base. So they were sitting around two months coverage, and they increased it to 3 over like that little window of COVID. So that was kind of the savings base that was sitting there. And that includes, basically 4.5 months or 3 months of coverage of like housing expenses and living expenses in total. So doesn't sound like a big number, but keep in mind that's like on average. So there'd be a lot of people that have
that's true.
much bigger savings bases, and some people that have less.
Be skewed by someone sitting with $1 million in their offset account.
Yeah, exactly. But if you're talking 4.5 months, that's still quite a fair few mortgage repayments that you could miss in its entirety before you're running it right to the ragged edge, so to speak. So with rates probably going to be really, really elevated over a maybe 2.5 year period. Having 4-ish months of cover, might be the difference that allows a lot of people to, at least on average, get through it.
The importance of this data isn't, in my opinion, the aggregate or the average. It's those at the tail end, those at the margins that matter a lot here, and what their cash flow looks like. This is the next bit of research that the RBA have done. They've dug a little bit more detail rather than picking up the high level aggregate. That's the macro position. People have 4.5 months worth of savings on average. Great. That's a nice, healthy resilience level. But how do individual households look at different spectrum sizes, at different ends of the spectrum, at different income quartiles, at different stress quartiles? Because at the end of the day, you only need a percentage of households, call it 5% or 2, 3, 4%. If they all start selling at the same time, that's they all lose their job at the same time. That's where the risk is. You don't need 50% of people to be in this boat. You need a small percentage, and that creates dominoes. And that's typically how these sort of real difficult economic circumstances play out. It's a large group of people, not the majority, but like 3, 4, 5% of households all feeling pain at the same time. That's generally how that plays out. And they've done some research here. Going into the next question, not how are Australians coping with high interest rates, but they're answering how will they continue to cope over the next year or two. And they've put the spotlight on where to look. And this is the key stat that I found is 5% of Australian households, according to their, I'm going to call it educated guesstimate. They got no idea really. They're just coming up with some answer because they need an answer to the question, and they are coming up with an answer for it.
It's all right. Someone's got to put a guess in. So, yep.
Yeah. And they've added some education bit by using survey data and whatnot in there, and they've come up with 5% of households are in negative savings. They've added another layer on top of that. 2% of Australian households are in negative savings with no buffers. They don't have mortgage buffers. 2% of households. Now, that's really interesting because if you check the arrears rate out, that is, if you throw all those 2% of people into the arrears rate, you are quadrupling the arrears rate pretty quickly, and it would be the fastest rise in Australian arrears that we've seen in a very long time. I don't recall last time we had a financial issue. Probably be before we were born. So that they've presented it in a low number, 2%. 5% sounds low, but if that translates, then that's concerning. But they do also say we don't expect a 1-for-1 here. It's not going to be 1-for-1. Many of these households have family members, have other solutions, can work their way through it.
So
people can sell.
There's hardship arrangements.
Exactly. Hardship arrangements. They talk about.
That's one they flag. Yeah.
So that was a really interesting component. So, how Australians coping, getting through it, and how will we continue to cope the longer this lasts. More and more households feel more and more pain, have less and less buffers, have less abilities to get through it. But the total quantum of households in this scenario, fairly low. And even if all of them get into a little bit of stress, many of those will not pop up into sort of arrears type data. We'll find other solutions. We'll sell, for example, and the market will get through. So they have that positive lens to it in terms of what the outcome will be, even though it is a slightly concerning number.
Yeah, and I think that positive lens is a useful thing to keep in mind, for property owners and investors as well, because if we as an economy get through this next 12 months in a pretty decent position, and on a household level, people scrape through and get to the other side of it and things are looking pretty healthy, then that means for asset markets, they're also in a pretty good position to see capital growth, price rises, things like that. So, if everything was going to go backwards in a hurry, then, there's no real prize for getting through this period if, everything's going to fall and collapse. But it's looking like we can get through this quite well. So there is that kind of light at the end of the tunnel if you're got a mortgage and you're holding assets that if you can hang on and get through the next 12 months, those assets are going to deliver for you basically. So that's, as an individual, that was kind of what I took out of going through this exercise and going through what the RBA have said. That's all right, it's not something where you go, all right, prices have peaked, there's going to be some impending economic collapse, so you may as well just get out now. There's no point hanging on. It seemed to be a much more positive story that look, for those people that can hold quality assets, there will be a payoff down the line associated with being able to get through this period. So it doesn't necessarily help, for the next 12 months while things are going to suck a little bit, but there is that kind of light at the end of the tunnel.
Yeah, I love that expression, light at the end of the tunnel. And the reason why I love it is the RBA actually kind of reference it. And this is one of my best takeaways actually from this report. Obviously, there's so much information, there's so much data. It's a great narrative about the Australian household. But they do also say in this report that yes, it's tough right now. Yes, we're going through a transition. We have coped through it, but we expect interest rates to fall. We expect tax cuts to kick in. We expect real disposable incomes to rise. Their expectation over 2024 and beyond is, yes, the economy is slowing down, all those things, but things are going to get better. And on the lever they control, on the very lever that they can change to make it better, they expect to cut interest rates. That is in their statement of monetary policy, but it is also in this report where they talk about all these households at stress being like, actually, you guys are under stress, but it's not for that much longer at this pain level because we expect to cut rates. We know tax cuts are kicking in. And the real disposable income fall that you talked about, that 7% fall, we kind of expect that period to be over. We expect wage growth to be higher than inflation over the course of the next year. So real income growth, you're not going to be going to the grocery shop and spending more there than what your income rise is anymore. That period is done. That is what the RBA expects. So if they go through this, the light at the end of the tunnel is coming. It's coming sooner than people think. So how are Australians coping? We have coped through this by and large, and it is about to get better. And our sort of analysis on this is 1 July is the starting point of it getting better with those tax cuts, and adding in the economist's view of when rate cuts are kicking in. It's only a couple months after that before rate cuts kick in, and each rate cut makes it that little bit easier. So light at the end of the tunnel is the right word for it.
Yeah, what a positive spin. I like it. I like ending on a positive. So hopefully, depending on when you're listening to this, whenever your next mortgage repayment is, there's some uplift associated with listening to this, being like, it's not all so bad. Or at least it won't be for that much longer.
Yeah, definitely. Curtis, always a pleasure. And to our listeners out there, if you have any questions on any of this or any suggestions on what you'd like us to talk about, obviously Curtis is here with me, absolute wisdom ball, really, really smart guy, can answer anything about anything on economics, property, housing. If you've got any suggestions or want us to answer anything, drop us a line at curtis@confidencefinance.com.au, and we'd be more than happy to, put an episode out there that answers your questions.